Okay, and welcome back. We're going to look at international trade and finance. We're going to look at balance of payments today. We already talked about comparative advantage and absolute advantage, and should countries trade, and how do we know if they should trade, and kind of the idea. We're not looking at actual trading deals, but we're looking at understanding at this level in introduction to macroeconomics. Why do countries trade? What is the importance of trade? When should countries trade, etc.? So let's talk a little bit about the balance of payments, and hopefully this lecture clears up a lot of confusion about what people think when they think of international trade. It seems a lot. It's 2020 right now, and with the past presidential election and the ideas of globalization going on, there seems to be a lot of negative views about trade. And we as economists, there are certain things about trade that are bad. It's not like there's always, right? This far in economics, we should know that there are always costs associated with anything that we decide to do, of course, right? But you should know that smart trade is good trade. And to quote Robert Kennedy, right, a rising tide lifts all boats. And in economics, we know that to be true, right? The best way to get people out of poverty and get people a good standard of living is open up markets to them and let them have the right to life, liberty, and the pursuit of happiness, right? And, of course, we can have a whole debate on what that means. But I think in the economic sense, that means property rights, owning rights, selling things, buying things, and having a government that protects those rights, right? Okay, let's move on. Sorry, I didn't mean to get all wax philosophical with you there, but a little bit. But I think those are things that everybody agrees with. All right, so let's look at balance of trade versus balance of payments. All right, balance of trade. So balance of trade, when we look at it in the GDP perspective, is your exports minus your imports, right? Your trade surplus, you have exports are greater than your imports. A trade deficit or a trade gap is when your imports are greater than your exports. And as Americans, we tend to think, oh, right, we have this zero-sum game of if you are exporting more than you're importing, you're winning. And if you're importing more than you're exporting, you're losing. And that is wrong. That is not the way to look at trade. It's not the way to look at your economy. That's a horrible way to look at it. There are some countries that export more than they import, that do well and don't do well. And there are some countries that import more than they export, and they do well, and some of them don't do well. But it is not an indicator. This is not an indicator of your economy doing well, right? If you have more exports than imports, that does not mean that your economy is, well, that must be the standard then, and you're doing great. The United States has one of the largest trade gaps, and our economy kicks butt. Right? So this is not, it just means that certain money and certain goods and services are flowing in a direction, all right, outside of the United States. But what is that inflow? And we're going to look at that and hopefully clear up some things for you, okay? Yeah, we don't have time to get into that. I'm sorry. Normally, if we were in class, we'd look at those trade graphs. Those are actually pretty interesting because, especially if you look at, and I'm going to pick on Trump only because he's president right now. I always pick on whoever's in office and doing things. I pick on them and I reward them. However, if they do something great, they do something great. If they don't do something great, I just think it's funny if you look at those graphs. Exports actually go down. Or have been going down since his election, which is interesting. So, balance of payments. All right, let's look at balance of payments. Balance of trade includes only goods and services, but balance of payments considers all international transactions. So we have to look at the balance of payments, all right? It is, I'll just let you take those notes, but it is basically the main part of it is it's broken up into two accounts. You have what we call a current account and a capital account. Okay, so the balance of payments has two accounts, the current account and the capital account. Okay, let's look at the current account first. Here's our current account, right? Which countries have the highest account surpluses and account deficits? Well, you can see the United States has a huge deficit, right? And Germany has a huge surplus, okay? Is that good, bad? What does that mean? I'm like, well, let's talk about it. Current account. The current account is made up of three parts. It's made up of trade and goods and services, right? So the balance of trade, right? Net exports, difference, inflows, exports, which is inflow of money, and goods and services that it imports. It's outflow of money, okay? So look at it this way. We export things, meaning we ship goods and services out, and then we have an inflow of money. Not to the government. No. That doesn't mean to the government. That means to industries. And goods and services, it's imports, right? What do we import? And that's an outflow of money, right? Not governments. These are companies and individuals that are doing this, right? This isn't, countries don't buy, well, I mean, they do, but they don't, right? The stuff you have on your shelf was most likely, it may have been subsidized by the government, but it was most likely bought by a private company, American company, who paid taxes on it and then supplied those to Target or Walmart, and then that tax gets put in, or that tariff or whatever gets put into the buying and selling price, and you pay it, right? So that's how that works, okay? Our next one that we're going to look at is investment income. So income from the factors of production, including payments made to foreign investors, all right? That can be inflow or outflow. And then net transfers, so money flows from the private or public sectors. Donations, aid, and grants, official assistance, etc. Right? That's an outflow or inflow of money. Our capital or financial account measures the purchase and sale of financial assets abroad. So real estate, equities, stocks, and bonds. That's a very limited amount of stuff, but those are the main ones that we'll talk about. Here's a news article from 2012. You can see I've been teaching for a while. But this headline is perfect. I don't know why I'd need to find another one. But in the 80s and 90s, it was the Japanese. Now it's the Chinese, eagerly buying up U.S. assets. So foreign firms see bargains here and opportunities for technological gain and expanded reach. So just to kind of go on a side note, yeah, we buy a bunch of stuff from the Chinese. And as you'll see later, what do the Chinese do with that money? Well, they turn around and they take that money and they invest it in the United States. So while we may have a current account deficit or trade deficit with China, we have a surplus in our capital account, meaning that the Chinese they don't know what to do with their money. So where's the best bet? They come to the United States, they buy up U.S. assets, invest, and that creates American jobs and helps us become, investors and things like that. It helps us become a more prominent economic force. So these are the purchase of things that stay in the foreign country. That's important. A distinguisher here. Purchase of things that stay in the foreign. So if you're wondering, is it capital or current? If it's a real estate, stock, or a bond, something that belongs to the country and stays with that country of origin, it's most likely a capital account. Again, here we go. You can see over here, cheap imported goods from China, right? Current account, U.S. dollars sent to China in exchange for cheap, because we're buying that stuff, as you'll see in our next video when we talk about exchange. We have to buy stuff from China. We don't buy it in dollars. We convert it to Chinese yuan, and we buy that. And then they ship that stuff over. We get it here. We buy the stuff. We go to Walmart. We go to Target. We go to Amazon. We go to your mom and pop's shops down the street. You buy that stuff. The Chinese are like, sweet, we just made a bunch of money. And then the Chinese are kind of like, okay, what do we do with all this money that we have? Where do we invest it? Do we invest it in China? Do we invest it in Germany? Do we invest it in Russia? And for the most part, the United States is still the best bet. We're very secure. We're very stable. And so a lot of people invest in the U.S. And so with that money comes back. Right, they convert their Chinese yuan to American dollars and buy our assets, and then now we have a surplus in our capital account, but a deficit in our current account. And if you look at the numbers, I actually had a student who didn't believe me once in class, looked up those numbers, and they were almost identical. And I said, what you have in your current account deficit, you'll have as a surplus in your capital account. And they're like, bull crap. I was like, yeah, almost always, right? And they looked up the numbers, and they're like, yeah, you're absolutely right. And I was like, yeah, I know. I wouldn't say it if if I, right? So anyway, it was a stupid story, but I guess it was worth telling. All right, so current or capital account. What I want you to do is I want you to take a second and figure out, is this a current or capital account? And then identify, is it a credit or a debit? Meaning, is it an increase or an inflow of cash to the United States? Or is it a debit, a decrease or outflow of cash from the United States? Okay, so pause the video. And we're back. Let's take a look at the answers for these. See how you did. There are the statements. And here are the answers. And I'll let you just go through those. If you have questions over them, of course, go back and review or get a hold of me. All right, more practice. So the U.S. income increases relative to other countries. Does the balance of payments move toward a deficit or a surplus? All right. The U.S. income increases relative to other countries. Does the balance of payment move toward a deficit or surplus? Let's look at the logic here, right? U.S. citizens have more disposable income. What are they going to do? Americans import more. Why? They're buying stuff from elsewhere. Net exports decrease. The current account balance decreases and moves toward a deficit. If the U.S. dollar depreciates relative to other countries, does the balance of payments move toward a deficit or a surplus? U.S. exports are desirable. Why? Because the dollar is weak. United States exports more. Net exports increase. The current account balance decreases and moves toward a surplus. Okay? That is it. The next lecture series is the last one, and we're going to look at exchange rates, and then we're done. So stick with it for one more. Until next time.